everyone. A very good afternoon. You're watching the newsroom on ET now. I'm Mubina Kapasi. Quick look at what the markets are up to as we speak. We are seeing some red on the screen. A bit of a somber mood really coming in for the equity markets today in trade with the Nifty 50 at 11,150. So taking a bit of a breather after that rapid run up. The Sensex as well is below 38,000. I would like to flag off one stock, or rather one company, and that's SBI Life, that is. The profit after tax came in higher by 5% on a year-on-year basis. We had the AUMs that came in at 1,753. The gross written premiums were higher by 14% at 7,640 crore rupees. That's about the numbers. Persistency ratio as well, did see a trend of 81.6% versus 84.5%. Let's talk about the numbers with Mahesh Sharma, the MD and CEO of SBI Life Insurance. Mahesh, thank you so much for joining us today on the show. It was expected to be a weak quarter, obviously, because of the lockdown. But despite the disruption, you were able to report a 5% profit growth. It was about street expectations. So what were the factors that contributed to this profit growth?
One of the things that we are seeing now is that June this year has been almost as good as June last year in terms of new business. July is even getting better. So out of the June results, we can see that June performance has been pretty good, and we had a very strong renewal performance. So we grew by 30% over last year in renewals premium. That was one of the factors. The other was that we had some group new business coming in, annuity, etc. So that also helped us, but that sort of made up for some of the individual business that we couldn't do in April and part of May.
Okay, renewal premiums reported good growth, but what are the kind of persistency trends that you are seeing given the backdrop that people are wanting to conserve cash at the moment?
Persistency has been pretty good. The 61st month persistency and even the 25th and 37th month persistencies have grown significantly. And the 13th month and the 49th month are slightly lower than last year, but that's only slightly lower, about 2% lower in the 13th month persistency. And this we see as, going forward, we'll be able to get more collections even out of those, because we don't see any reluctance on the part of people. I see a very mature kind of buyer out there of insurance who realizes that insurance is a very important thing and is not really compromising on that in this effort to conserve cash or whatever. Maybe other discretionary spends are going down.
Okay. VNB margins, those managed to improve to 18.7%. The higher margin protection segment share was down to 10% versus 14% in the overall NBP mix. So what are the factors that aided margins?
So the VNB basically has, three components. So one is the volume of new business, then the new business margins, and the persistency. So you see some of these go in opposite directions. So as a result of that, what has happened is that the volume of new business itself has come down compared to last year. And that has actually, our overall VNB has come down due to that. But the VNB margins, because of the mix, and it's not just a factor of protection, because there are other elements also in that. So some single premiums, some regular premiums, persistency, like I said, in the 61st month bucket and all. So, a lot of those things have also helped in the margin getting better.
Okay, is there a scope for margin expansion in the coming quarters, and where do you see them sustaining at?
The margins will probably remain flattish by the end of the year. We don't see them going suddenly higher or something. But going forward, let's say 2-3 years, we will, because of the improved product mix, we are making some changes, and we will obviously be focusing more on protection, because that is the need of the hour, and I think the public also accepts that very much. So going forward, we do see a trend towards more protection. The market would itself expand, because there will be people who are not insured going in for protection for themselves. So that will probably aid us to increase the VNB margins going forward, but that will be growth over a period of time.
Okay, the banker channels account for 41% of the overall NBP distribution mix. Disbursements, credit scenario continues to remain under pressure. So update us on this channel, and do you see the distribution mix to be heavily biased towards the digital medium?
Banca has actually Banca has shown a slight decline over last year in terms of the mix, because we lost a significant amount of time in April and beginning of May, when people were not moving to the banks. So that has actually impacted the percentage. But otherwise, we expect, and going forward, we expect the banca channel to be one of the major channels for us. It will continue to be so. We have more bank partners. We are trying to add even more. And so as a result of that, banca channel will continue to remain strong. We are also adding agents. So agency channel will also grow. What we are looking at is a general growth over the next few years. This year, of course, it will depend a lot on how it opens up. But we are hoping that by the end of the year, we'll be able to show a slight growth out there. Digital is definitely the flavor of the times, and digital will grow and probably grow exponentially going forward. We do have a lot of hopes pinned up on our digital offerings, and we are offering more and more products on digital. Like, for example, just to give an example, our Insta Life secure protection on digital channel with SBI on their YONO channel, we have been able to cover 195,000 lives in the first 3 months of the year.
Can you comment on the pricing of your term plan rates? Because premium has increased by 30%, particularly by private players owing to increase in reinsurance rates. So, given the challenging environment, do you see this impacting the growth?
We have always been pricing our products very, very sustainably. So even now, we don't see a spike in any of our protection products. So Purna Suraksha, for example, which we have launched, it's a term cover with which also covers 36 critical illnesses. We don't see that price going up in the near future. Of course, there will be the cheaper products that we have. Some of them may get repriced going forward. Part of it will be due to the reinsurance also. But I don't think we are going to be affected to that extent, because our prices are done sustainably, and we do tweaking every now and then when we decide that it is too far away from sustainable levels.
Okay. What is your strategy for growth? Are you looking at inorganic growth opportunities? How do you intend to grow your market share?
Our idea to increase the market share, one of the things is to focus on increasing the market itself. So you expand the market. We are very customer centric. We also think about the insurance industry and the market in India, and we find that we are woefully undercovered. So that would be one of our prime targets. So educating the customer or sending out messages that we need everybody needs protection would be one of the things. The other thing is, of course, penetration, in the sense of we have a very strong presence in both agency and in banca. So we will try to cover all the areas where our partners are present, where our agents are present. So that will be the second one. And the third will be persistency. So to convince our existing customers to renew their insurance on time and not to get affected by small short-term difficulties. That would be one of the things that we will be doing. We'll, of course, our product mix covers almost every segment. We have a product for each and every Indian, and we will continue. SBI Life will continue to support the growth of the insurance industry, and we think that that is the best way for us to grow.
All right, great. Mr. Sharma, thank you so much for joining us today on ET Now and breaking down the quarter gone by for us. Quite a robust one, and that too at a time of course, the entire lockdown that we found ourselves in the midst of.